Let's move to the components of the financial statement. There are 5 main parts, which are statement of profit and loss, balance sheet, statement of cash flows, statement of change in equities, and notes to accounts. Now, here's the thing. When a business is run, it's not just dealing with the random numbers. Everything is recorded in a proper, organized way through them one by one. Statement of profit and loss. So first, we have the statement of profit and loss. This one is all about performance. It shows whether a business made a profit or a loss over a specific period of time. Simply put, it defines you what you earned and what you spent. And at the end, it shows the final result, which could be either profit or loss. Now next is the balance sheet. This is more likely a snapshot. It shows what the business owns, what it owes, and what belongs to the owner. So basically assets, liabilities, and the equity all in a one place. And the key idea here is simple: what you have versus what you owe. Now let's talk about cash, which is statement of cash flows, also known as real money moment. The statement of cash flows shows exactly that. Where the cash come from, and where it went. It tracks money in 3 areas like operating activities, investing activities, and the financial activities. So its answer is simple question: where did the cash actually move? Now moving on to the equity, which is statement of change in equity. This statement explains how the owner's shares change over time. So think like profit added, money withdrawn, or any other changes in ownership value. In short, it connects the beginning equity to the ending equity. And finally, we have notes to account. Now this is important because this is where the detail lies. It explains the numbers shown in the financial statements. So if something looks unclear, the note gives you the full explanation behind it. You can think of it like the behind the scene of financial reporting. So when you put it all together, these 5 components give a complete picture of a business: profit, position, cash moment, ownership changes, and detailed explanation. We'll go deeper into it in upcoming videos. And that's how financial statements actually tell the full story of a business. So now we'll look at the users of the financial statements. Financial statements are not just made for one person. They are used by different people for different reasons. And broadly, we divided these users into two groups: internal users and the external users. Let's go through them. Internal user. So first, internal users. These are the people who are inside the businesses. They directly work with the company and uses financial information for decision making. For example, management and owners. They use financial statement to understand how the business is performing, where the money is going, and what decision to take next. Internal user use the data to run and control the business better. Now let's talk about external users. External users, these are the people outside the business, but they still need financial information to make decision. Like for example, investor. So investor, they want to know if the business is worthy putting money into. Lender or banks, they check if company can repay loans. Government authorities, they use it for taxation and regulation. And even supplier and the customer, in some cases, they want to understand the stability of a business. External users rely on the financial statement to decide how safe or beneficial it is to deal with the business. So when you combine both internal users and external users, internal users manage the businesses from inside and the external users evaluate the business from outside.